Hi everyone, this is Dr. Kiran Kumar, Associate Professor, Department of Professional Accounting and Finance, Chris Jayanti deemed to be University. In this video lecture, I am going to discuss about the module number 4, Interpretation of Financial Statement. Under that, the main topic is additional performance measures, non-financial measures and reporting. Before going to introducing the topic of additional professional performance measures, let us give me the main importance and advantages of additional performance measure. Any investor, before going to investing in any stock or any instrument, he may go for analyzing and understanding the nature of the stock. After that, he may take a decision. And coming to the analyzing and understanding stock or investment point of view, he may refer or apply the various tools and techniques for evaluating the stock or any instruments. So with this regard, we are going to identify the some of the important additional performance measures along with the common traditional measures like funds flow statement, cash flow statement, ratio analysis, trend analysis, sales growth, comparative analysis and common size statements. So in this we are going to discuss the some other important tools and techniques which will help a lot and support to their analysis. First one is here EBIT, earnings before interest and tax. This is the another important tool for understanding the before interest and tax, how much a company paying interest and tax from the profit, so that stockholders or investors come to know how much a company paying interest and tax. Second one is EBITDA, earnings before interest, tax, depreciation and amortization. From this tool, investors or evaluators come to know how much a company deducted depreciation and how much the company paying for the operating expenses. Third one, net financial debt, gross debt less cash and equivalents and other financial assets. With this regard, investor like to know about the cash position and debt position, how much they are using for payment of debt. And last one, free cash flows. This is another important tool or a technique required for understanding the liquidity position of the company. So whenever analyst or an investor want to know the liquidity position, solvency position, they may go through this statement. After that, they may take the decision either to continue or exit. Coming to the next important topic, that is benefits. What are the benefits applying the additional performance measures? Though all traditional techniques giving an idea to the investor for taking informative decision, additional performance measures are also giving some kind of more information for understanding more about the company which are not covered under the traditional performance measures. So let us start with the benefit of additional performance measures. Helping users of financial statements to evaluate an entity through the eyes of management. So these techniques helps to the company management to know the major areas where they are lacking and where they are supposed to cover or where they are supposed to reduce the cost. Second one, enabling comparison between entities in the same sector or industry. So it is up to the evaluator or company management to select any type of tool or technique for comparing with another company in the same industry. So where traditional tools are not covered the major areas, these additional performance measures will help them to identify the gaps and identify the strengths and weaknesses of the company. Third one, stripping out elements that are not relevant to current or future year operating performance. To understand more and able to compare with other companies, here selected performance measures can be applied. Coming to the third topic, that is drawbacks. Though those techniques are additional performance measure and modern techniques, even all these modern techniques are also having some drawbacks. Let us start with first point, first drawback of additional performance measures, that is an entity might calculate an APM in different way year on year. That means whatever they applied the additional performance measure in the previous year, it may not be possible or it may not be interested by the management to apply in the next coming year or current year. Why? Because there might be changes in the reports or in the performance of the company. With this regard, APM techniques may not be applied by the management or evaluators. Second one, two entities might calculate the same APM in a different way. Especially additional performance measures need more information for understanding the financial performance of the company. With this regard, if they miss any kind of information or if they skip the more important information, chances of getting results may be differ from one party to another party. Let us take example EBIT and EBITDA. EBITDA, in this technique depreciation is required to calculate the EBITDA. Now there are two different types of depreciation. Some companies may apply the straight line method as per the standard norms, and some companies may apply the diminishing balance method as per their standard norms. When the different companies applying different depreciation methods, it is going to affect on profits where highly required by the investors. So with this regard, companies may have a problems or issues while calculating the APM. Third one, entities often provide little information about how an APM is calculated or how it is reconciles with the figures presented in the financial statement. If any company or a investor want to apply the APM, some kind of information or extra information is required to do. With this regard, companies may not ready to provide the information. So what entities or companies or investors used to do, whatever the information is available, considering and calculating and trying to convey something about the company. So with this regard, chances of missing the actual data and understanding the company in deep way is very difficult. Next, APM is might be selected and calculated so as to present an overly optimistic picture of an entity performance. Again, another important biggest task of the evaluator is to select the appropriate tool based on the availability of the information. Why? Because there are so many tools and techniques available for evaluating the financial performance of the company. But the next problem is here selecting the suitable and best tool is very difficult. So with this regard, investors or company management may be difficult to select the suitable technique. and those techniques may not give the results as per the expectations of the company or else company management. And last drawback, that is, too much information can be confusing to users of the financial statement. As per the accounting standards, all companies are trying to prepare the reports as per the standards. If the companies are trying to give more information along with that, there is a chances of miscommunication about the company, and investors may not understand the properly about the performance of the company. Thank you so much. Have a nice day.